Good evening, all. Welcome back. So, like last time, have the same wonderful interaction. So it was absolutely pleasure so discussing all these provisions with all of you. So before we go to the session, I welcome Nitya Sethuraman.
Good
Nitya,
evening, sir.
good evening. So Nitya is actually the 46th rank holder in the previous examinations, and she also scored 76 in income tax. More than anything else, she's one of the most active participant in the class. So whenever if nobody answers the question, I can straight away go to her. Nitya, what's the answer? So in fact, she will be willing, ready to answer every question. So I said, you just keep quiet. Let me try with this. I'll come back. So it's always been pleasure teaching to her. I thought since she's also rank holder with all of you, with the delay in the examination, I think needs some kind of a motivation. So of course, I took the privilege of disturbing her just 5 minutes before I
No.
pulled her out of her dinner. So I hope that she finished her dinner. Hi, welcome,
Yes, sir.
Nitya. So how are you doing now? So COVID la எப்படி இருக்கு?
Yes, sir. It's very, I mean, like, obviously, I understand that, that's what is there on everybody's mind. So, I don't know how. It must be very, very difficult for the students who are writing in this attempt because எப்போ exam இருக்குனே, like, they are not sure. First May இருக்குன்னா, then they said it's in June. Now, I think it's in July end. So, having that on the mind and studying itself is a big thing. So Anala, I cannot even imagine what's going on their minds because I remember last year when there was some confusion regarding the date of our exams because of I think elections. Until the last minute, they didn't tell us that the exams were going to be held only in the end of May and in fact in June only. Otherway, and the 1 month delay with the surety that the exams will be held at the end of May, that itself we found difficult to study and motivate ourselves. So now I mean I just hope that all the students and you also are safe. I hope everybody is doing okay.
So one thing is about this class is like this class has got many Nityas. That's one advantage you have. A lot of students, very, very active participants in the classes. And the moment I just come back and say like, oh, what is the answer? I give 2 minutes time, you'll find the answer. And what is
Okay.
most important is happening this in the physical class was not a big difficulty because we face to face. But even in this online sessions, they are brilliant. I thought I am sure that
Okay.
most of the students will get a rank. I thought maybe
Okay.
if you are 5-10 minutes of today's session, that will also motivate them to score a lot. So can you share a few thoughts of yours before we go to the session?
Yeah, sure. Thank you, sir. First, thank you for giving me the opportunity to address these students. So, just a couple of things which I thought I'd probably share with you guys, which you might find helpful for your exam. So, see, so like one thing which I found as a little challenging when it came to tax, but also one of the reasons why I felt it was one of the most interesting subjects to study is we've not studied tax as a subject ever before. We've not encountered the subject in our lives before. If you take any of the other subjects, be it accounts, be it law, which we've done in CPT, or be it economics, which we've done in school, at some point in time or the other in our lives, we have interacted with that subject. Whereas the first time we even studied about something called tax right from the ABC was only in the inter stage. So I think I would really like to thank TG sir for the way he taught us the subject and equipped us with the maturity to approach the subject, because that is also fundamentally very important. So that was one thing which I faced not as a challenge, but as something that was different about the subject. So the second thing was, see, tax is a very, very voluminous subject. So the only way you can ensure that so much voluminous information is going to remain in your head, not just for the duration of 1 or 2 months before your exams, or in the 3 hours that you're writing the exam in the examination hall, but for a sustained period of time, is to write it. So whenever TG sir says anything in class, like I feel it's very important to just note it down, because while you might sort of digest the concept and what he's saying at the spur of the moment, it is not only important that you understand the concept, you also have to be able to recall the concept at a future point in time. So when you're revising, when you're doing your last minute revision, say 2 days before the exam, it will be very difficult for you to go through every provision in every page of all the 3 volumes of the study material, or even TG sir's book that he's giving you. So whereas if you just have a look at your notes, one big factor is you would have written it in a way that you understood it. So when you go and look at it again and when you read it, you will easily be able to understand, because nobody else has written it. So making that notes is I feel something very important. And now if you've not been doing that thus far, I'm pretty sure most of you would have. Even if you've not done that, as much up until now, you still have 2 months. We're still in May, and I think your exams are only in the end of July. So you can still start making notes, which will help you in your last minute preparation. And another thing is, don't get scared of the subject. Okay, like I know a lot of people who studied along with me who liked tax, who really enjoyed studying it, but they were daunted by the sheer volume of the subject. So like don't approach it as something that it's so difficult, it's so voluminous, how will I ever be able to finish it? Because if you don't approach it with if you approach it with fear, then the more hard it is going to be for you to master the subject. So that I feel is something that, and don't fear the subject, is basically what I wanted to say. And apart from that, this one thing which I think TG Suresh sir used to keep saying in class was like, never revise anything new before the day of the exam. Like that is only just going to freak you out more, because as it is, tax will probably be your 4th exam, if I'm not mistaken. So you'll already be mentally exhausted having written 3 exams. So whatever so you wouldn't have studied tax probably for 15 days. And tax being tax, unless you constantly keep revising it, you are going to lose touch with the subject. So exam Kumindiranal, whatever you have already studied might start seeming unfamiliar, and you might just be like extremely puzzled by reading something as simple as as simple as something you learned on the first day of class. So that itself it'll take you some time to get into the rhythm of the subject. So don't try to do anything that's very bizarrely new or completely different from what you've been doing thus far, because that is not going to help you. There is not going to be any value addition in doing that on the day before the exam. While it is important to get as much coverage as possible, try to ensure that you get that. Now that you've gotten like an extra 2 months to study also, you can use this maybe probably the next 1 month or so to get that coverage that you want. So just probably my suggestion would be to not open anything new on the day before the exam or on the morning of the exam. So that is another thing which I wanted to share. So apart from that, these are the 2 or 3 things which I wanted to share. And don't go into the exam with any expectation that the paper is going to be so difficult, because I remember in my batch when our exams got delayed by a month or a month and a half, a lot of people were saying exam delay paniyache, so the paper difficulty level will also increase, and there were a lot of rumors like that floating around. So don't let things like that affect you. See, because at the end of the day, you have put in the effort that you think is capable from your side. So you can't control how difficult the examination paper is going to be. That's really not something that's in your hands. So don't, instead of putting effort and spending time thinking about extraneous factors like that, because that will only daunt you. Because then even when you see a very simple question, you'll see the question and you will try to impute meaning into it. You'll be like, how can it be so simple? It has to be more difficult than this. You'll unnecessarily waste time. So don't go in with any preconceived notions. I feel I feel that is also something that which maybe some of my friends did, and then after the exam when we were discussing, they said that that's probably not something that they should have done. So yeah, so that's another thing which I wanted to share. But apart from that, I think you can completely surrender yourself to TG sir, and like if you just do what he says, that is more than enough. He will give you all the coverage that is required, and he will give you all the revision that is required. I think he'll give that MCQ sheet also during the last few weeks of revision and class and all of that. So you can just completely go through the material that he's giving you, and he's, as you all are very aware, I'm sure he's very approachable. So you can ask him whatever doubts you want. So you can completely surrender to him, because that is what I did and it worked for me. So I can confidently say that is something you can also do. So yeah.
So thank you, Nitya. Thanks for taking your time. So
No,
guys, if you have any question, you can put it in the chat. Also, I can ask the question, because so you can't directly interact with her. We have ensured that unfortunately we could not do it. Maybe like in some other Zoom session we can call her and also we can interact. But if you have any questions, you can always feel free. And so I'm sure that only thing, as I said, Nitya, there are many Nityas in this class. There are so many people give so much of answer at such a pace. I think it will be a very, even they continue in the online sessions is nothing brilliant. So thanks for your time. We'll catch up soon. So all the best.
no.
Give my regards to your dad also. So thanks for
Yes,
coming
sir.
on a very short note. Thank you.
Yes, sir.
Bye.
Thank you so much for giving me the opportunity, and all the best to all the students. Like, I really hope, I'm sure they'll all do very well based on what you're saying. I'm sure they're all going to do very well in the exams, but good luck to all of you. And in case if any of you have any, like if you want to reach out to me or ask me anything, I'm sure you can ask TG sir for my number, and I'll be happy to speak with you. No issues about that. Yeah.
Okay. Thank you. Good
Thank you,
night.
sir. Thank you for giving me this opportunity, sir. Thank you.
Okay. Yeah. So, right, friends, welcome back. So, we'll start with, has always been one of the topics of my heart. And I think, in fact, the fond for the subject of many people is so much. So, even my name is T.G. Suresh. Um, They have even changed my name to, instead of TGS, they also, some people even have the habit of changing to CGS also. So I think to that extent, a lot of people are able to relate me with capital gains is something which is quite interesting. Um, so there are a couple of amendments which has come in capital gains, which are going to be very, very important. So, so that is going to actually make any examiner is generally interested in, like as far as the examiners are concerned, or anybody is teaching tax is concerned, is always capital gains is going to be something very special for them. So capital gains is such a very, very fascinating topic. It's so fascinating. Even if I'm suffering from temperature of 104, or even so, at any kind of health conditions, one topic if you can take is definitely capital gains. It's such a beautiful topic. I always used to say that whenever you are feeling bored, you don't want to study. So the best thing what you can do is don't watch any film and all. The capital gains is a wonderful film. So that's film which you can always watch. It's a terrific chapter. Though I will not be discussing the entire chapter, but we'll discuss about the two amendments. One of them, I'm sure, is the most likely to come is the amendment of Section 54 of the Income Tax Act. So, so the amendment of Section 54 of the Income Tax Act is so important. Generally, that section is important. It's going to become even more important on account of this amendment. So let us try to find out what is that amendment which is made in Section 54. Now, so at present, any long-term capital gains arising from transfer of a residential house, if invested in one residential house in India, will be eligible for exemption under Section 54. So any long-term capital gains arising from transfer of a residential house if invested in one residential house. Even this particular amendment was made in assessment year 2015-16. Till assessment year 2014, instead of one, we had a residential house. One is not there. Instead, they had a residential house. In India, was not there. So essentially, the section will say arising from transfer of a residential house if invested in a residential house. So this is how the section was worded. So one important issue at that point of time. So what is the meaning of the word a singular? Should that be taken as one, or whether it will also apply for multiple houses also? Can I claim exemption for more than one household? So what is the meaning of the word a? A is a singular. So under the General Clauses Act, the word singular will also include plural. So therefore, we all of us used to argue before the department, even if a person buys more than one house, you should give exemption for all the houses on account of two reasons. One, the word a singular appearing in section 54 should be also taken as a plural. Secondly, the purpose of this section is to encourage housing, and therefore the benefit of exemption should be given to all the houses. However, the government view or the income tax department's view is that the word used is a, it's a singular, you should take it as only one. And though the purpose of the section is to incentivize housing, the government believes that housing should be encouraged and encouraged So this is their view. As the matter went on to the courts also took a liberal stand that the word a singular should be interpreted as more than one. So you can claim exemption for any number of houses. So therefore, what they did was they made a change. So they want to clarify, but in one stroke they made two changes. If invested in one residential house in India, earlier, it was a residential house and one residential house in India. So this was interesting. Two changes were made. One, A was made as one, and two, they also added the word India. Now, why this India should be added? I had one my student friend who was residing in US, and his family has got no intention to come back to India, but he had a house in Bangalore. So that Bangalore house he wanted to sell, and he wanted to purchase a house in US. He said, I don't want to come back to India. Can I purchase the house so that my capital gains can be completely invested without paying tax? Now, the answer is yes, because earlier the section was using the word earlier. The transferred property must be chargeable tax on the income from house property. But the new house you purchase, they did not say that new house must be taxable under house property. So as he is a non-resident, the property is in Bangalore, that property is taxable in India under income from house property, because all of you will be aware of once income accrues in India, residential status is irrelevant. Subsequently, if you purchase the house outside India, that part of the section did not talk about whether that property should be taxed on the house property or not, since there is no specific point. So a lot of people took a stand that investment need not have to be taxed on the house property. That means that can be also outside India also. So therefore, in one stroke, they made two amendments. One residential house in India. This was a change which they made from assessment 1560 to clearly specified, I want to promote housing only in India, and two, that should be restricted to only one, because one is a necessity, more than one is a luxury. So again, all of you will be aware of under section 54F, you can purchase or construct one residential house in India out of any asset transferred other than a residential house. Anything other than residential house in residential house 54F. Residential house and residential house will get the exemption under section 54. Both 54 and 54F are available only for individual and HUF. And the existing section of 54 itself puts additional conditions like SSC should not purchase for a period of 2 years or construct for a period of 3 years more than one residential house. Besides, you should also not own more than one residential house, more than one residential house on the date of transfer. Now, so what is the amendment? So these are the existing provisions in 54 and 54F. I have also given you the backdrop also so that you can appreciate this particular point. Section 54 has been amended from assessment at 2021 to provide the exemption can be claimed for two residential houses provided the following conditions are satisfied. The long-term capital gains should not exceed 2 crores and the SSC can avail this benefit only once. Now, it should be noted that the capital gains should not exceed 2 crores and not the consideration. So, we have to be careful. Sometimes, whether we'll get the confusion has to whether the consideration should not exceed or the capital gains. But the section is very clear. The long-term capital gains should not exceed 2 crores. And the SSC can avail this benefit only once in your lifetime. The logic is same as what we discussed at the time of house property also. In income from house property also, all of us, we discussed at that point of time. Earlier, you can have only one residential house for self-occupation. The logic is same. One house is a necessity. More than one house is a luxury. You have to pay tax. But there is a relaxation in 23 that if you have more than two houses, then only the property will be considered as a deemed to be let out property. So that is something which possibly we have explained the reason also at that point of time. The same logic applies here also, because many times the family wants to live together. At the same time, they want their own space. Therefore, people come back and say, I will stay in the next street or in the same flat or in the next door or nearby street within 500 meters. Let me have my space. You also have space. So, but however, so it's a separately together. So we'll have the benefit of nucleus family as well as a joint family. In fact, the finance minister himself spoke about this particular point. The two houses may be required by the SSC, one for him and one for his parents or children. So that is why he said two houses we can take it to zero. Similarly, that is the same reason they also said we will extend the exemption to two residential houses, but with a small rider that your capital gains should not exceed 2 crores and this benefit can be availed only once in your lifetime. Now, so the question, this section comes into effect from assessment at 2021. For assessment at 2021, all of you know the previous year is 1920. So previous year 1920 starts from 1/4/2019. One more point all of us will be aware of. The new residential house can be purchased 1 year before the date of transfer also. So let's assume for a moment I sell the property on 1st June 2019. I can purchase from 1st June 2018. But this provision came into effect only in the month of February where the budget was announced. It was passed before the elections. So therefore, can I apply for houses purchased before 1st April 2019 also? Because when you purchase two houses before 1/4/2019, at that point of time, the law did not say you can buy two houses. Therefore, one logical question arises, if I use the option of buying 1 year before, whether the two houses concept will still apply? The answer to me is yes, because T4 says from assessment date 2021, you can claim exemption to two houses. The section never said that you should purchase on or after 1/4/2019. That means even if you purchase using the option of 1 year before the act itself came into effect, still the benefit should be given to you. Though my contention in a different section might look different for you, because when we discuss about TDS provisions, I will put it differently. Don't confuse as if I'm taking double standard, one for 54 and other for TDS. Let me make it clear here itself. In 54, it is an exemption provision. Therefore, it needs to be construed liberally. right? That's what the reason. And this is a provision which is meant for the benefit of the SSC, therefore, has to be interpreted more liberally and logically. That's why this stand. If subsequently it appears to you that I'm trying to take a position which is different for one section, different for other, let me make it very clear. You have to read it harmoniously. It is, you can't interpret 54 and 194 in the same way. Both have a different operation. So the same way also we can interpret differently. So what is very important is, though 54 has been amended, 54F has not been amended, and hence exemption will be available only for one house in that section. You can't apply these two houses for 54F. But what is more important is, if you buy more than one house in 54F, it is a violation of the section. 54F puts a condition. We already discussed there is a condition in section 54F that you should not own more than one residential house. You should not construct more than one residential house. So, therefore, I have already put specifically that in 54F, these are the additional conditions which are required. So what if you buy two houses in 54F? It becomes a violation. That means the exemption will be withdrawn. The exemption will be withdrawn. But if you buy two houses in 54 and if you satisfy the condition, you can claim exemption for all. If you buy two houses and if you don't satisfy the conditions of 54, this additional conditions of 2 crores, then you can claim exemption for one of them. So therefore, I'm going to give you three examples based on this particular point, like what we have done in the past, in the previous session. So give you 5 minutes time for you to go through the question, solve the problem, come out with the answer. We have discussed the provision. Maybe we are at 8:29 now. Something similar to this you can expect in the examination. One of the three examples on the similar lines you can expect for this examination. So like us always, spend some time, 5 minutes for you to try the answer. Not a difficult question. I don't think it will take more than 5 minutes time, but it's a very good question. So S sold a vacant land on 1st November 2019 for 450 lakhs. The cost of acquisition amounted to 100 lakhs as on 1/4/2001. He purchased two residential houses, one in Chennai for 80 lakhs and another one in Mumbai for 120 lakhs on 31st March 2020 and 30th July 2020. Compute the capital gains chargeable tax with assessment date 2021. Cost inflation index 100 for 2000-2001 and 289 for 2019-20. As usual, 5 minutes for So since we have got the two answers of 81 lakhs, we'll just go to that. So three answers of all of them are 81 lakhs. Surya, Ramanathan, Sriram, Aishwarya, Magesh, Archana. How so many people are getting 81 lakhs of an answer? So this is very interesting. But is it 81? That's the question. That's where you missed the trick of the question. This is 54F, right? Vacant land sold and invested in residential. You are not eligible for 54. You are eligible only for 54F. But it's already told you, if you buy two houses in the case of section 54F, then it is a violation of the section. That means you will not get the exemption. This is the trick. So you can also go through the notes which is already given in the site. So it's a good fast try, but the only point is that sale of land and purchase of residential house will make you claim exemption under 54F. But in 54F, if you buy more than one residential house, exemption will be nil. So the answer is 161 and not 81. But anyway, it's a good try, very fast try. But I'm very surprised that everyone is getting 81 lakhs. So 1, 2, 3, 4, 5, 6, Surya, Ramanathan, Sriram, Aishwarya, Archana, Omega. So 81 lakhs is the popular answer. 161 lakhs is the correct answer. I'll put that way. But good try. That's the attempt is what is very key. Don't worry about whether you're right or wrong, but the speed and the attempt. So time and again, you're showing that even in online classes, you people can interact. That's something very special about this class. So just move on. We'll try another question. சொல்லுங்க ராமச்சந்திரன் கேளுங்க chat பண்ணுங்க அப்படியே என்ன டவுட் ராமச்சந்திரன் chatல போடுங்க அப்படியே டவுட்டை So to your question, if you buy the same year, you will not get exemption. If you have bought the house, claimed exemption, and subsequently if you violate, then in those circumstances, your exemption will be withdrawn. So that is the difference. See, you don't have to disclose, Ramchandran. Today, the department has got enough reporting. These transactions are now getting reported. So therefore, in any case, if you don't disclose, you will be caught. So if you go by that kind of a methodology, how can you hide your investments? And we are really talking about the tax planning year, right? So we are not talking about tax evasion. If you don't disclose, it's a tax evasion. So I think this class will not discuss about tax evasion. We'll discuss about tax planning and tax avoidance. How do you should do the transaction legally, no? So Nitin Shanai after the silence is back. So 261 lakhs. So Nitin, why you didn't answer the previous question, I don't know, but you waited and now giving the answer for this one. So any other, we'll just wait for a few more minutes as to, we'll just find out whether some other answers comes. So Nitin, like yesterday, is back in action. Vignesh, the capital gains exceed 2 crores for your question. If the capital gains exceed 2 crores, you cannot claim exemption for the two houses. That's all. See, here the condition for 2 crores is to claim exemption for both the houses. Nil capital gains. Surya ji, why nil capital gains? Interesting. See, I've changed the consideration at the beginning. Akhilesh also put zero. Akhilesh, question 450 lakhs, 550 lakhs. So many nil answers, but the first answer of Nitin Shanaik is the correct answer. Is the question or some other answer? So here the point is that there is one very important difference between 54 and 54F. In 54F, if you buy two houses, you will not get exemption at all. In 54, if you buy two houses, if the capital gains exceeds 2 crores, then you will get exemption for one house at your option. If your capital gains does not exceed 2 crores, then you will get exemption for both the houses. So that is a small but very important difference here. So here the capital gains comes to 261, which is more than 2 crores. So therefore, the exemption can be claimed for one house at the option of the SSC. I have two houses, one for 80 lakhs and one for 120. So therefore, I can claim exemption for 120 lakhs. So I think interestingly, I think the reason why most of you have got it as nil is because you have taken a stand that FMU on 1/4/2001 is 150 lakhs. Maybe most of you might have taken the cost of acquisition as 150 lakhs. See, the option of taking the cost at FMU on 1/4/2001 is only if you purchase asset before 1/4/2001. If you purchase exactly on 1/4/2001, you don't get that option. That is one point to be noted here. So here the date of purchase is exactly 1/4/2001. So market value is on 1/4/2001. Substitution here is not available. So that's why your capital gains amount is changed. So if you buy on 1/4/2001, you can't substitute. So that is a crucial point. So how the problem changes? That's an interesting one. Right? If you have taken the cost as 150, then your capital gains would have come to below 2 crores and you can claim exemption for both. That's why most of you got the capital gains as zero. So you got the capital gains as zero because of that particular point. But you can't take the cost as 150. So that's where Nitin got it down for right. But unlike 54, in 54F, in 54, if you buy more than one house, it's not a violation of the condition. You are entitled to claim exemption for any one of them at your option. See, don't bother about the silly mistakes. The purpose of giving this kind of questions is that you have to be slightly careful. All mistakes you can do in the class, right? You can always do everything you can do here. Only thing is that you should not do in the examination. See, the moment you do mistakes in the class, you will not do in the exam hall. So don't worry about it. So all these things are good lessons. Just take it. So just to borrow the Hindustan Liver advertisement, Karai Naladu, stain is good. That's it. So therefore, we welcome mistakes. But again, as usual, the speed at which you guys are trying, that's what's most important. I think we'll have one last concluding question. Will an answer differ if the consideration is 450 lakhs instead of 550 lakhs? Just quick answer for this question. Consideration is 450 instead of 550. The rest of the question is same. So we already have some answers. I think the capital gains would have come to 161. So it's going to be restricted to 161. So since the capital gains now has not exceeded 2 crores, you can claim exemption for both the houses. So now just slightly moving out of the examination here. Now the only one point which we should consider here is I'm just talking about how this is a very fascinating topic and how you should eventually think. It's good. It's a very, very good answer from the examination point of view. But however, let's just think a minute beyond the examinations for a moment. Now, what is the challenge where the government did not think about this challenge? This is where the opportunity lies for us as a professional. Now, suppose if this asset is sold subsequently, I purchased two houses, one for 120, one for 80. Now, this 161 is out of which asset? That's the question. Now, suppose if I sell the house with a cost of 120 lakhs or 80 lakhs, if I sell both the houses in the same year, not a problem. It's most unlikely that I'm going to sell both the houses in the same year. If I'm going to sell one of the houses, so typically assuming that I'm selling house which costed 80 lakhs subsequently, you all know if I'm going to sell the house within a period of 3 years, the cost of acquisition is going to be reduced by the amount exempt, right? So the amount exempt from tax is going to be reduced. Now, when I sell the house which is costing 80 lakhs, I might take a contention, right? I might take a contention. This 161 of mine consists of 120 of the Bombay house and 41 of this. Therefore, I would reduce only 41. Whereas the income tax department could take a slightly different stand. They may come back and say, boss, if 161 consists of 80 from this, 81 from that. So therefore, the one challenge on this provision, which was not addressed so far, they will not also address because it's a new provision. So just the way I'm only trying to trigger the way in which you should think. One is do this question in the examination point of view. Fantastic, all of you have done already beautifully. but just move to the next level. That is what is very important. Going to the next level. You just always think what phone you want, an Apple or Lava. Always want an Apple. We want always the best. Yeah, that's what is important. So here also take the best. Don't stop. Don't content yourself. Don't stop yourself. Don't stop. You are so brilliant. Just expand. There is no need for us to stop only with the examination. Travel beyond the examination. So here that will be the challenge. We don't have an answer right now. It could be proportionate. It could be 121st. It could be 41 of those. It could be four. So anyway, it's going to be the combination which we don't know. But there are some exciting, interesting times ahead. When somebody is claimed exemption like this, they will have an interesting issue to handle in future if they are going to sell this house, any one of these houses, within 3 years, which is a violation of the section, and that violation results in some interesting questions. So we'll keep the questions. Answer, of course, we will be in a position to discover. Each one of us are entitled to try our own. So if you have any specific questions on this is one section. You can be rest assured it's going to be there in the exam. Normally, capital gains at the intermediate level is there as a question number 4 because of the by and large. If you see the last exam, first question is on the total income. The second question generally is house property. So normally the fourth question or the third question, capital gains picks up after the introduction of this 30 marks of MCQ. So at the intermediate level, you always find the capital gains figuring out there. So when such an important amendment is made, I'm sure that will definitely be in the focus of any examiner. It's almost, we can say, it's a done deal. So 99 out of 100 times that should be there in the examination. So if you have any questions, please feel free to put in the chat. So if you don't have it, then I will go to the next section. It's a very interesting one. I feel this will be a very nice multiple choice question. Sure, it will come, but more likely to be a multiple choice question rather than a question as a full question at the intermediate level. At the final, it may come as a full question, but at the intermediate level, it might come more like a MCQ. More questions? Right. So says 46A of the Income Tax Act deals with the buyback of shares. So buyback of shares is dealt with by section 46A. So whatever amount which is paid by the company for buyback less cost of acquisition was taxed as a capital gains under 46A. However, the provisions of 46A was applicable only for listed shares, only for listed shares. For unlisted company shares, the provisions of 46A was long back, it was not applicable. So you have to instead pay a tax called as buyback tax. So that means the company has to pay a buyback tax for unlisted companies. So this buyback tax was levied at the rate of 20% plus surcharge plus cess. And once you pay the buyback tax for the shareholder, the entire capital gains was exempt from tax under section 10 subsection 34A. The reason why they brought the concept of buyback tax, there are certain countries, though we have to which India has got the double taxation avoidance agreement. We discussed this many a times. So there are in certain countries like Singapore, Mauritius, Cyprus, and all. So there is no capital gains tax in those countries on transfer of shares. But because of the double taxation avoidance agreement between India and those countries, it is taxable only in the resident country. So in the resident country, the same was not taxed. So therefore, there was a planning which many private limited unlisted companies were doing. Instead of paying us a dividends, which is subject to dividend distribution tax, but the dividend distribution tax has been levied in the hands of the company. The shareholder doesn't get any double taxation relief because company is paying tax in India, shareholder is paying tax in that country, and therefore the relief is also not available. That means these dividends are getting taxed twice. So therefore, many companies move to the buyback route, either to pay only one tax or at least get no tax at all. Now, similarly, the listed companies also started being more of buyback instead of dividends after the introduction of a new tax for the dividends. Dividends are already going to be paid only after the tax. After that, the company pays the dividend distribution tax. After that, shareholder will have to pay tax at the rate of 10% in excess of 10 lakhs. That means there is no double taxing, it's a triple taxation. First you pay tax, then company pays the tax, then shareholder pays the tax. So there were multiple levels of taxation. As a result of it, Indian companies, listed companies also started following the concept of buyback over dividends. So what the government did was, in this year, it's a very interesting year. We have to be very careful. If the public announcement for buyback of shares is made by the listed company before 5th of July, that means up to 4th of July, then if you also finish the buyback before 5th of July, then no buyback tax. Shareholder will also not exempt. Shareholder will have to pay capital gains tax under 46A on the difference between buyback price minus cost or indexed cost. Again, the buyback is announced before 5th of July. 5th July is nothing but it's the day on which budget is actually presented by the finance minister in the parliament. This is Finance Act number 2 of 2019. So which was presented on 5th of July. Finance Act number 1 was presented on 1st of February. But buyback happens on or after 5th of July. Again, they say it is not taxable. Any buyback which is announced up to 4th of July, even if the buyback is actually executed after 5th July, no problem. Again, shareholder alone will have to pay tax on the capital gains and there is no buyback tax. If you make the announcement on or after 5th of July, buyback also obviously should be done after 5th of July. Company will pay buyback tax. For shareholder, it will be exempt from tax. Watch for this question at the intermediate level on MCQ and at the final level, it will be there as a separate question. So if the buyback is announced before 5th July, that is up to 4th July, whether you do the buyback before or after, there is no problem. 46A will apply. Shareholder will have to pay capital gains tax. No tax for the company. So if it happens on or after 5th of July, then you have the company has to pay the tax. For shareholder, it will be exempt under 1034A. 1034 provides for exemption for dividends. This is provided by 1034A. So 1 or 2 marks of MCQ is what you should try at the intermediate level. Separate question maybe for the final. So that is one. So next we'll move to one very small but very important amendment in section 9 and section 56 of the Income Tax Act, 56 to 10. Right. So now all of us will be familiar with the equation on in provision on 56 to 10. 56 to 10 is basically provides for taxation of gifts. So the taxation of gifts under 56 to 10, any person receiving from any person, the sum of money or property, so will be taxable. So the company receives any person receives from any person sum of money or property referred under 56 to 10. Now the one important issue is how do you apply this for a non-resident? Where does the income accrues, right? The place of accrual of income and place of receipt of income is very important for a non-resident. That's to recollect section 5. Income should be either earned in India or received in India, then only a non-resident will be taxable. A non-resident will not be taxable if the income is earned and received outside India. So how do you decide this? For example, if I transfer sum of money to my friend in US, where does income accrues to him? It does not accrue to him in India. So the gift will be complete in respect of a movable property only in the place where the possession is given. Suppose I take some gold to him and give the gold to him. If he takes the gold in India, then it becomes taxable. The place of accrual of income is India. If I give him the gold outside India, then the question of taxing this income does not arise because of the fact the place of earning and receipt of income is outside India, which is not taxable for a non-resident. So therefore, some practical challenges were there because many a times people transfer the amount from India to the non to a non-resident, and such non-resident claims it is not taxable in India because the place and receipt of income is outside India. So to plug this loophole, they have not changed anything in 56.2, but they changed section 9. Section 9 is income deemed to accrue or arise in India. So income will be deemed to accrue or arise in India. That is section 9. In section 9, you have section 9, subsection 1, clause 8, which provides that income of the nature referred to in section 224, 17a, which is nothing but 56.210, arising outside India from any sum of money paid on or after 5th July 2019 by a person resident in India to a non-resident or a foreign company shall be deemed to accrue or arise in India. So be careful. It's a very important provision. Whether you are inter final doesn't matter. It's always good. This section is very important. Income of the nature referred to in 224.17a, which is nothing but 56.210, arising outside India from any sum of money on or after 5th July 2019 by a person resident in India to a non-resident or a foreign company shall be deemed to accrue or arise in India. I'm going to the next slide, bifurcate this. Step by step, cut the section. You'll find it very interesting. The income arising outside India from any sum of money paid. Just look at the second line. 56.210 is applicable. 56.210 is applicable both for money or property. Right? Any sum of money or property, both are subject to 56.210. But when you come to section 9, it says income arising outside India from any sum of money paid. Recall our classroom discussion. We started by saying gift tax. We gave the history. You now understand the importance of the history. First, it was a gift tax act, donor based tax up to 98, then 56.25, then 56.26. Both 56.25 and 56.2x both were using the word sum of money. Property was included only under 56.27, right? First time 56.27. 56.25, 6, 7, all were applicable only for individual and HUF before we introduce a new section 56.210 from 1st April 2017, where from any person, and sum of money or property. But interestingly, in section 9, They use the word only sum of money. That means if the amount is paid by a resident to a non-resident, only cash or sum of money is covered. Any other amount properties are not covered. Movable properties are not covered. So what if I courier a gold or a jewelry to my friend outside India? Whether it will be considered as income deemed to accrue as in India? The answer is no, because the section talks only about sum of money. On or after 5th July, again we considered this particular point. Why 5th July 2019? 5th July is a date on which this budget, this finance bill was presented in the parliament by the Honorable Finance Minister. So therefore, till 4th of July, it can be anything, no tax. This transitional year, be careful. They may give you, you might think that you pick section 9, but they may put a small twist there. They may put a small twist by saying that the gift was made on 1st of July or 2nd of July. You might come to a conclusion taxable, but the answer is not taxable because the provisions are applicable only from 5th July 2019, which is the date on which this budget was presented. To a non resident or a foreign company by a resident to a non resident. So, what if a non resident is gives to a non resident? No problem. Section won't apply. It must be by a resident to a non resident. Though 56(2)(10) shall be deemed to occur as in India, as I already mentioned, though 56(2)(10) applies to the property, section 918 will be applicable only for sum of money. Very interesting point. If a resident gives to a resident, cash property, everything is covered. If a resident gives to a non-resident, you will have a small issue. So similarly, well, the TDS provisions will apply under section 185. So the section says income chargeable to tax, and therefore it is possible to take a stand that 195 will apply, which is TDS for non-resident provisions. Up to this point, watch out, very, very important provision. You all know that importance of 56 to 9 and 56 to 10, a combination of it. You need to watch out very closely for this examination. Watch on the date, watch on the sum of money point, and it must be paid by a resident. So, first time when you read this section, you would not have even seen there are so many points that there you would not have even thought about. When you bifurcate the section, when you see the section, you find there is a big difference. So, very, very interesting provision. So, if you have any specific questions, please go ahead. So, I have few questions are there in the chat box. I'll answer that first. But I think I've answered all the questions asked by friends. So, Right. So, so welcome back on. So, a couple of questions relating to the buyback. Let me address that question. So, to understand the main point of discussion here, when the budget was announced, so what is specified here was, so if the buyback is, so on 5th of July, on the day of budget, so what they specified was the buyback should be completed. So if the announcement was made on or after 5th of July, is what the current law talks about, irrespective of when the buyback is done. So if so, subsequently, when this point was pointed out, that if the company has already announced the buyback before 5th of July, and if you make them applicable this particular provision, this will become a retrospective provision. So therefore, for all buybacks announced before 5th of July, the section should apply. So though initially the government did not accept this particular point when the bill was even passed, but when the ordinance was introduced, the Direct Tax Amendment Act of 2019 was introduced. So they made a change in proviso to 115 QA without doing any corresponding amendment in section 1034A. Therefore, on a plain reading of the section, it appears that in a scenario contemplated, that is, the announcement is made before 5th of July and the buyback is done after 5th of July, on a very simple plain reading of the section, it appears that, as some of you pointed out, it's neither taxable in the hands of the company nor the shareholder. This is slightly an aggressive stand. That is what it appears from the plain reading of the section. However, a more logical stand, which I'm sure that the government will clarify, is that if you pay buyback tax, it will be exempt from tax in the hands of the shareholder. So if you don't pay the buyback, just like your dividend distribution tax type. So if you so the way in which what I have given is what is there. So just I'm giving you a backdrop for an easy understanding. I think some of you have asked this very good question. So basically, when the budget was introduced, when the budget was passed, Finance Act number 2 of 2019, they said the buyback, even if the buyback is completed after 5th of July, you have done the announcement before 5th of July, but if you're going to complete after this 5th of July, you have to pay only buyback tax under 115 QA. This was the proposal. This is how the act was passed. The suggestion made was not accepted, that this would mean it becomes a retrospective operation, was not accepted by the government. But subsequently, when they introduced one more change to the assessment in 2021 through the Direct Taxes Amendment Act, they modified 115 QA by introducing the proviso without making any change in 46A, so which gave an impression, which I'm saying, I'm just making very clear, which gives an impression that both in this second situation, it won't be taxable in hands of both. But that is not the intention. The intention of the legislature is if you pay buyback tax, you will get exemption 1034A. If you don't pay buyback tax, 1034A is not available. So therefore, from the examination point of view, it is better you take that stand. But though it is there, what is there in the section, it is there like this. But a more logical view of the provision should be, if you pay buyback tax, exempt. If you don't pay buyback tax, shareholder will have to pay tax. Make it very simple so that you don't try to take this aggressive stand from the examination part of, because we know how the law evolved. Therefore, we can take a slightly different stand. But in examination, let's make it a little bit more simpler and you take a stand. If buyback tax is paid, it's exempt. If buyback tax is not paid, it's not going to be exempt from tax. So you just keep it that simple. So just with this, we will move on to the most popular topic at the intermediate level. Very surprisingly, the last ever since the MCQ was introduced, and ever since the separate marks were allotted for Chapter 6A redaction, we have not seen a separate Chapter 6A redaction question in the examination at the intermediate level. Maybe this attempt could be that breakthrough attempt. So where you may get a separate equation on Chapter 6 redaction. So clubbing set of Chapter 6 redaction at the intermediate level has a separate marking allocation. So therefore, I am of the opinion that there should be a question on this in the current examination. So a lot of interesting amendments were made. So considering the fact that these amendments are definitely some very important amendments, and new amendments are also, new sections are also introduced, and therefore you have a very good chance of getting some of this in the examination. Though the first of them is EEA rather, is not exactly new. This section was there in the earlier avatar of 80EE. That was the original section. So now it is there in the form of 80EA. In fact, very interestingly, they used to introduce this section once in 2 years, and with the reason being same, for promotion of housing. So 80EA, who is entitled reduction? It's an individual. Payment qualifying for reduction. Interest payable on such loan would qualify for reduction. The amount of reduction. The maximum reduction allowable is 1,50,000. Conditions and other points. Loan should be sanctioned during financial year 1920. Sanctioned, that is very important. You don't have to abide the loan. The sanction letter should be there in that period. The stamp duty of the house should be less than 45 lakhs. In the earlier avatar of the section, they talked about the cost, but in the current provision, they talk about the stamp duty value of the house should be less than 45 lakhs. The guideline value is what they are trying to suggest. The individual should not own any house on the date of sanction of loan. On the date of sanction, you can have before that, you can have after that. But on the date of sanction of loan, you should not own any house. The individual should not be eligible to claim deduction under 80E. That means if you have already claimed 80E, again you should not be given 80E. That's the point they are trying to mention here. The benefit of deduction of the section would be available from assessment at 2021 and subsequent assessment years till the repayment of loan continues. The reduction of up to 1,50,000 under 80EEA is over and above the reduction available under 24B in respect of interest payable on the loan borrowed for the acquisition of residential property. In respect of self-occupied property, so interest reduction is restricted to 2 lakhs. Therefore, basically the way in which you should try to look at the purpose of this particular section will be, so if you take a loan, so beyond say 2 lakhs, you will get deduction under section 24B only up to 2 lakhs. You are paying interest of say 3 lakhs. The remaining 1 lakh you will be entitled to claim under this section. So the whole purpose of the section seems to be, if you are going to take a loan on which interest payable crosses 2 lakhs, then that interest in excess of 2 lakhs you can claim under this section. So basically you can go up to 3.5 lakhs. That's what we can come to a conclusion. So the only thing, as I said, on the date of loan, not on any other day, on the date of sanction of loan, don't have any other house. And the stamp duty value of the house should be less than 45 lakhs. So basic purpose of this section, as you can easily understand from the way, is promotion of housing Since already you are getting only 2 lakhs under 24B, another 1.5 lakhs you will get under 80EEA. So new section, which is again, before we go to the new section of 80EB, so one of the condition is that you should not have claimed reduction under 80EE. So 80W is saying your loan should be sanctioned in previous 16-17. There you are getting a reduction of interest or 50,000, whichever is less. Unlike this section, it talks about stamp duty value should be less than 45 lakhs. The earlier section put two conditions. The cost of the property should be less than 50 lakhs and the loan should not exceed 35 lakhs. Two conditions. But today now you have only one condition. The stamp value of the property should be less than 45 lakhs. But if you claim this section, you're not entitled to claim 80EEA. That means somebody has already taken that 50,000 benefit. They will not be in a position to get 1,50,000. So 80EEB, this is something which is a very interesting section. So basically, the electric vehicle. So how the Western countries were adopting, instead of trying to incentivize by way of a deduction, they generally create a lot of charging stations. The problem with electric vehicles is that so India does not have enough charging points. So what will happen if you're stuck somewhere? So that is where it became unpopular, but the government felt one way of, because our import bill was pretty huge on account of the import of oil. So the government was consciously working towards the concept of moving towards emission-free, more a greener India, whatever name you want to call. So one way of doing this is to encourage buying of electric car. If you use the car for the purpose of your business, you are entitled to claim reduction under 36(1)(3) of the Income Tax Act. And if you are not going to use the car for the purpose of your business, under normal circumstances, if you take a car loan and if you use the car for personal purposes, you're not eligible for any deduction. So what they have done here is that, so if you buy a loan and if you go to use it for the business purpose, claim it under 36(1)(3), and if you go to use for personal purposes, then you will get deduction under 80EEB. So basic idea is to encourage purchase of electric vehicles. So eligible assessee, like the previous section, only individual. This is not available for HUF. Normally, Chapter 6 deductions for payments are available for HUF also, not this section. So interest payable on such loan would qualify for deduction under the section. Quantum of deduction is interest subject to maximum of 1,50,000. So in 80EEA, we discussed about you have to take the loan between 1st April 19 to March 2020. But here you can take from 1st April 1919 to 2023. I mean, for a period of 4 years, any of those 4 years, you can take. The loan should be sanctioned in that period. The loan should be taken for purchase of an electric vehicle. The loan should be sanctioned by a financial institution, a bank, or specified non-banking financial company. If you claim reduction under this section, reduction will not be available under any other section. If you are in business, then you can claim reduction under 80EEB. So one of the sections, I feel that 80EEB has got a pretty good chance for the examination, given the fact that something which the government has consciously been trying to work out. The last segment was TDS, advance tax and filing of return of income. So this was done by the Finance Act number 1. So currently under section 194A, TDS is required to be deducted at source if the interest for a senior citizen exceeds 50,000. Other than senior citizen, the amount of interest, if it is paid by a banking company or a cooperative society or a post office, the limit was 10,000. And if the amount is paid by any other person other than a banking company or a cooperative society or a post office, the limit was 5,000. So, when the first Finance Act of 2019, the pre election budget, so what they've done, they've increased the limit of 10,000 to 40,000. So, only one change, 10,000 to 40,000 was a change. That means that 50,000 for senior citizen, no change. Other than banking company, cooperative society, post office, 5,000, no change. So, therefore, 10 has become 40, 50 has remained 50, 5 has remained as 5,000. So I just put a comparative table. If the person responsible is a banking company, other than senior citizen, from 10,000 moved to 40, senior citizen 50, cooperative society 40 40, post office 40 50, any other person 5,000 5,000. So that means it's very important note, interest on company deposits continue to attract TDS if the amount of interest paid exceeds 5,000. For section 194 DA is another very important change. Section 194 DA contemplates deduction of tax at source on payment to a resident under a life insurance policy not exempt under 1010D if such payment or aggregate thereof during the financial year is 1 lakh or more. The TDS is required to be deducted at the rate of 1% on the entire proceeds of the policy, including insurance premium paid by the policy holder. Just to give you a backdrop of 184 DA, general presumption for any person is that amount received from an insurance policy, he thinks it is exempt from tax. That is also true. Insurance policy is a capital asset, is normally exempt from tax. But 1010D puts certain conditions. There are certain policies which are not subject to exempt from tax. So let's take an ATC. You might have read in ATC to claim deduction at ATC for LIC premium. The premium paid has to be less than 20% for policies taken before 1/4/2012. 10% of sum assured if the policy is taken on or after 1/4/2012. If the policy is taken on the person who is suffering from disability of the nature referred to in 80U, or a person who suffers from any disease or ailment referred in 80 DDB, 10% will be 15%. Suppose if my policy is 2 lakhs and I paid a premium of 50,000, I will not get the entire 50,000 deduction. My deduction will be either 20% or 10% or 15%, depending upon the date of policy and the person on whom I have taken the policy. But what is very important is for such policies, if you receive on maturity, such policies are not exempt from tax under 1010D. Such policies are actually taxable. So most people are not aware of this. They have not shown this in their income. And how do you track this? So the one way of tracking this is always the TDS. TDS is a mechanism under which you widen the tax base, ensure that some other person reports your income so that the trail is there and you can be captured. So widening of tax base, reporting the current income. So that's why this 184 DA was introduced. But the insurance company has to cut on the entire amount 1%. Some people were offering this income under income from other sources. But when they offered this income under income from other sources, they will claim the amount of insurance premium paid and then only show the net amount. Assume I get 5 lakhs. I paid insurance premium of 2 lakhs. My taxable amount will be 3 lakhs. So this is also acceptable because in income from other sources, the amount you paid for the insurance premium is allowed as deduction. But insurance company will say the amount paid is 5 lakhs, TDS deduct is 1%. Therefore, they will report as if you have earned 5 lakhs of income. But you will show only 3 lakhs as income. Therefore, there is a disconnect between what is reported in the TDS statement and what has been reported by the SSC as the income. That's a disconnect. So this resulted in some needless assessments, needless additions. So what they have done is they have amended 194 DA that going forward the TDS will be deducted only on the net amount, but instead of 1%, the rate at which TDS deducted will be at the rate of 5%. So this amendment will be effective from 1st September 2019. So what is the impact of this? So up to 4th September or up to 31st of August 2019. So if you receive an insurance amount and you have paid insurance premium say of 4 lakhs, so TDS they will deduct at 1% of 10 lakhs. So effectively what they're going to do is, so if you are going to receive up to 31st of August 2019, if you receive 10 lakhs and you pay insurance premium of 4 lakhs, so TDS will be deducted at the rate of 1% of 10 lakhs. Now, what is the amount of income you are going to show in your income tax returns? You will show 10 lakhs minus 4 lakhs. You will show 6 lakhs. So this is one of the challenges. So therefore, what they have done is from 1st September 2019, instead of deducting 1% of 10 lakhs, the insurance company will deduct. The insurance company will start deducting at the rate of 5% on 6 lakhs. So this is the very interesting amendment. Watch out for this. You know that there is a separate marks is allocated for TDS. So when they allocated marks for TDS and when you have a lot of changes happening in TDS, I think it's definitely a simple casework for this examination. Very simple. We don't have to do anything. It's not a rocket science. A chapter on which marks were reserved. A lot of changes were made. Changes were made in the middle of the year. So therefore, these questions are something which all of you should expect in multiple choice. Expect this in your normal question. So only thing, watch out for the dates. That is very, very important. So the date is very, very important. So here, if you take the same case, so from 1st September 2019, take the same example. So see the ticker there. So from 1st September 2019, if you receive 10 lakhs and you pay an insurance premium of 4 lakhs, so you have to deduct TDS on 5% of 6 lakhs. So if you take up to 31st of August, 1% of 10 lakhs. From 1st of September, TDS will be deducted at the rate of 5% of 6 lakhs. That is the implication of this particular amendment. So TDS, a lot of changes, very, very important for this particular examination. So let's now move on to the next section. So wherever you have a doubt to specify, so we can just take it up. So very simple amendment is on 194I. So up to last year, this was also made by Finance Act number 1. So all amendments of Finance Act number 1 you can find. Amendments were made relating to house property or real estate. You can buy two houses or 54, one house earlier zero, two houses zero. TDS on rent increased to 2 lakhs 40,000. So the limit for deduction under section 194I from 1.8 lakhs increased to 2 lakhs 40,000. So that is about 194I. Again, very important amendment. So next one is 195 TDS on purchase of immovable property. So all of you will be aware of purchase of immovable property will attract TDS at the rate of 1% if the consideration paid by the buyer to seller is 50 lakhs or more. You don't have to get the tax deduction account number, and you have to deduct TDS on any land or building or both except rural agricultural land. Now, so normally when if you're been aware of this buying of big properties, what will happen normally under those circumstances? So if you book a flat in the 20th floor, the builder will come back and say, boss, you have purchased 20th floor, high-rise building, charges for that. Then we'll come back and say, we have a gym in our flat, in our apartments, gym charges. Again, maintenance. I'll have some maintenance charges. We have a club, use of club. So there is, you will be allotted one car park. You want additional car park, additional car park. So therefore, your purchase price will be split for parking fee, high-rise building, swimming pool, so on and so forth. They charge in multiple manner, split the transaction. Sometimes on account of the split, consideration could come down to below 50 lakhs. Just like in the school, ATC also will be aware of tuition fees allowed. But if you see the fees, they will put tuition fee, they will fee admission fee, this is a donation fee, that fee, this fee, and all. We all will think that everything is a tuition fee, but there is a difference between tuition fee and the admission fee, the donation, so on and so forth. So multiple this thing. So the builders also created a similar culture. So where what they did was they split the consideration and they said there is no requirement for direct TDS because the section was only talking about for purchase of immovable property. All these facilities, amenities, and other things will not be covered by the section. And therefore, if your purchase price crosses 50 lakhs on account of the TDS is not required. So again, what they've done is they've changed from 1st September 2019 the definition of consideration. They said the consideration shall include all charges of the nature of club membership fee, car parking fee, electricity or water facility fee, maintenance fee, advance fee, or any other charges of similar nature which are incidental to transfer of the immovable property. So essentially what they are trying to come back and say from 1st September 2019, so the meaning of purchase consideration is going to be inclusive of all the charges. So that's what they are just trying to provide. Again, the same question which arises now. What is the position up to 31st of August 2019? So up to 31st of August 2019, what should you do? So since this amendment is very clear that this amendment talks only about from 1st September 2019. Therefore, from your examination point of view, so up to 31st of August 2018, you can take a stand that this explanation will not apply. So, so again, watch out for the date in the exam. So the position which you have to take till 31st of August 2019 is what is crucial. So since the amendment is made only from 1st September 2019, so up to 31st August 2000, up to 31st August 2019, you can take that this explanation will not apply. So the most important aspect of this discussion is the amendments were made during the middle of the year. Therefore, just watch out for these provisions carefully in the examination. Watch out for the dates. Sometimes you may not know why they have given the dates. They might have given the dates for a different reason, which we may not be aware of. So be careful, TDS. I don't have to tell you the importance of the TDS. So TDS is going to be such a very, very important one. So watch out for this. These amendments are something which will definitely be in the radar of the examiner. So I'll just move on to the next amendment. So just quick clarification on the point which I was talking about, one additional point there. So what will happen if the project is completed before 1st September 2019, but you have to pay these amounts after that date? So we talked about for the projects which are not completed. So what should be the position you take? The 1st September 2019 cutoff we talked about. This is a very interesting discussion. Just to recall, most of the provisions of Income Tax Act under the TDS provisions would like you deduct TDS at the time of credit or payment, whichever is earlier. See, in 194 IA, it's going to be basically the property is going to be purchased in most cases by an individual who need not have to maintain books of accounts, and he may not even maintain books of account for these projects. Typically, assume all of you, any one of your parents have purchased a property. I don't think they're going to maintain books of accounts for this. They may have a list of what to whom they paid, how much is the cost, that they will maintain, but they may not maintain any books of accounts for this. So therefore, a question of crediting this in the books of accounts does not arise. So what therefore, after the project is completed, you have to pay this maintenance fee and all the stuff. So whether you have to deduct TDS, the answer is yes, because of the fact that the section will apply at the time of credit or payment, whichever is earlier. And since you would not have shown this in your accounting because you may not have maintained, even if the project is completed, if the builder comes back and says, "But these are the amount you have to pay," and if that happens after 1st September, you may have to pay TDS on that. So that is something which is very interesting. For projects completed before the date on which section applicable also may be subject to TDS on account of an interesting reasoning which I provided. So this, in my view, is the section which you will get. So 99.99%, the question in the examination will be on 194M. Now, what is this 194M is all about? Now, currently the TDS provisions are applicable under section 194C for an individual or HUF or an AOP. So, if they are subject to audit on the basis of monetary limits under 44AB in the preceding financial year. So, if you are not subject to tax audit, TDS will not apply. So, the government found there are many cases where a lot of people who are constructing properties are not actually paying the TDS because there is no requirement. An individual is not required. So, but these transactions are not getting reported. So the trail of the transaction is missing. So a lot of people construct some huge projects. The project's running in crores. But if it is for a personal use or if it is not for the purposes, if you're not subject to tax audit, the TDS obligation is not there and these transactions are not getting reported. So therefore, what they've done is they've introduced a new section from 1st September 2019 that if you are an individual or HUF who is not required to deduct TDS under 194C or J or H, then you have to deduct TDS at the rate of 5% on the base of payment or credit, whichever is earlier. So under 194C, just recall you have to deduct TDS at the rate of 1% or 2%, depending upon whom you're going to make the payment. So under 194J, you have to deduct TDS at the rate of 10%, and under section 194H, there will be at the rate of 5%. Whereas in 194M, though all the sections are covered, they have kept only one rate, which is 5%. So they did not say if you pay to a contractor, you have to pay 5% for professional fees. So that to that extent is good. They did not confuse you too much. But entire payment to a contractor or professional services or commission of brokerage will attract TDS at the rate of 5%, provided the aggregate amount paid during the financial year does not exceed 50 lakhs. You don't have to deduct. That means if you cross 50 lakhs, TDS is required to be deducted. Like 194 IA, for this section also, they said you don't have to get the tax deduction account number. They said TAN is not required. Contract professional service commission, they said this, you take the same meaning as we are given in CJ or H. So again, the point is that it's applicable from 1st September 2019. 197 provides for lower deduction of tax. And 197A gives you a self-declaration. If you want to receive the amount without deducting details, you can give a self-declaration under Form 15G or Form 15H, that is 187A. In 197, you go and approach the income tax officer for lower deduction. So therefore, the question which arises here for 194M, can I go for a lower rate of deduction to the assessing officer? Yes. But can I give a self-declaration under 15G or 15H? No, which is 197A. But I can apply for a lower deduction. So what is very important to note, threshold limit. No deduction is required if the aggregate amount paid during the financial year does not exceed 50 lakhs. That means for a 50 lakhs amount, you should see for the financial year, which is from April to March. But when from the section, the applicability date of the section is 21st September 2019. So how do you interpret this point? I have to deduct TDS only when it is credited or paid after 1st September. But for arriving at the limit of 50 lakhs, I will also take April to March. Very, very important section of this exam. I'll just give you one small example. As usual, you can spend some time. Just try this question. So I think quite some time since we have talked about, we have involved you in the session now. So almost after some gap, just giving you an option to give answer. So Vignesh, the catch is the amount of TDS. TDS to be deducted is fine. What is the quantum? Amount of TDS is the key. Sriram Balaji has given the answer of 3 lakhs. See, the section is applicable only from 1st September 2019. Murugan Karthi 75,000. So he's got the answer right. So Murugan Karthi. So let's look at the analysis and the answer from the examination point of view. First point, TDS is recorded only on the amounts paid or credited after 1st September 2019. But for applicability of the section, all payments credit from 1st April to 31st March you should consider. So therefore, you have to deduct TDS at the rate of 5% of 15 lakhs one day, because any creditor payments before 1st September is not subject to TDS. I can't introduce section from 1st September and ask to deduct TDS for the earlier payments also. So that is definitely not possible. But since the amount paid or credited during the financial year, you may have to take the amount up to, so from 1st April to 31st March also, but TDS will have to be deducted only for the payments made on or after 1st of September. So therefore, those who got the answer of 3 lakhs 5,000, you may be applying on the entire amount, which is not the correct answer. But don't worry about it. But that is why I gave this problem. So you have to deduct TDS only on the payments after 1st September. But for calculating the limit, we will take from 1st of April. That is the beauty of this particular question. So 194M were not required, TDS will be deducted. So TDS is required deducted if the aggregate amount paid in the financial year exceeds 50 lakhs. TDS is required at the rate of 5%, but only on the payments after 1st of September, which is only 15 lakhs. So 5% of 15 lakhs is the answer and not the entire amount. So it's a good try. See, like these are all gives you an option of knowing. Why I'm giving you a few minutes for you that you know that. So where sometimes you can go wrong. So maybe it may be a repetition. Unless we make a mistake, sometimes we may not be in a position to understand. So make mistakes to learn the subject better. So these are the sections I will just skip. So these are all talking about what is 184C, what is 184H. So we are already at 10 now. So insertion of 194N again from 1st September 2019. Who is liable to deduct tax? So I have a gentleman from Indore. So who may be very happy to see this provision. Who is liable to deduct tax? Every bank, cooperative society engaged in banking or post office is required to deduct tax. So every bank, cooperative society engaged in banking or post office, the rate at which you are deducting is at the rate of 2% if the aggregate of cash withdrawn during the financial year exceeds 1 crore. So if you keep withdrawing the cash, possibly you will not get the full amount from 1st September 2019. So they want you to apply the provisions of TDS. So, however, this section will not apply. The payment is made to the government. So, any banking company or a cooperative society engaged in carrying on banking business. So, if you go to Alvapet Anjaneya Temple, you know the land markage TNST bank is there. Post office, any business correspondent of a banking company or a cooperative society engaged in banking business in accordance with the guidelines issued in this regard by RBI. Any white label automated teller machine operator of a banking company or a cooperative society engaged in banking business, and such other persons or class of persons as may be notified by the central government in consultation with RBI. So, what is very important to note as far as this particular provision is concerned? So, if your cash withdrawal crosses 1 crore, TDS will be deducted, like what we explained in 194M. If the amount withdrawn up to 31st August will also be taken, but section will apply only from 1st September, assuming that you have already withdrawn 1 crore before 1st September. 1st September, you withdraw a cash of 10,000. The bank will deduct 2%. So that means, though the sections apply from 1st September, the same point. Another point, what will happen if you withdraw from an ATM? So the problem is the ATM machine will give you full amount. I don't think ATM is capable of, when you put a deposit of 10,000, it will only release 9,800. I have my own doubts. So in those circumstances, how the bank will do this? Maybe they may charge your current account. The second point here is that normally when TDS is deducted, the credit for TDS is going to be available to you. The credit for TDS is going to be available to you in the year in which you offer the income for tax. So if I say, for example, you make a payment of professional fees to me of rupees 1 lakh, you have deducted 10,000. So I have to offer income of 1 lakh, and while calculating the tax, after calculating the tax, I can adjust the TDS deducted by you. So the 10,000 TDS deducted by you is income deemed to be received. That's one. And I can also claim the credit for TDS when I show this income for tax. Section 198 is a section which talks about incomes that are deemed to be received. So in 198, they're saying this amount is not 194M, is not income deemed to be received. So therefore, since this is not my income, one question which is going to be a dispute of the future, that can I take the credit for this TDS when I file my tax returns? So this is again another provision. They would have not thought about all these points. So typically what happens is, normally first we do and then think. So a lot of countries first think and do. So we have this very unique habit of first do, then we'll think. So why you think while doing? First you will do, then you will think. So first the proposal of 20 lakh crores is announced, and after that proposal followed. Likewise. So first you say and then you follow. So not that you first do in reverse. So that is one of the interesting aspects about how life moves in our country. So just move to another one. It's a very interesting amendment. So this amendment of section 201 and proviso and section 48. So basically, what is this 201? We need to explain briefly what is 201. 201 basically talks about assessee in default of the TDS provisions. Suppose if a person who should deduct has not deducted, or deducted but he has not paid the amount. So he is going to be called as a person assessee in default. Suppose if you have to pay me professional fees of 1 lakh, for some reason, TDS Suresh is a nice man. How can I deduct TDS for him? You are such a very kind people. So what you have done is you have paid that amount to me without deduction of tax. So you are an assessee in default under 201. But 201 proviso was introduced into the Income Tax Act because there was a very interesting decision by the Supreme Court in the case of Hindustan Coca-Cola or Thumbs Up, Coke, Sprite. So whenever you just see that bottle or when you want to drink it, think of this amendment. So what the Supreme Court said, you have made the payment to TG Suresh without reduction of tax. TG Suresh has shown this in his income and has paid the tax. So you cannot therefore recover TDS again because TDS is the one mode of recovery of tax. Normally, when the tax is payable by the assessee, he has to pay by way of a TDS or by way of advance tax or by way of a self-assessment tax. That is one reason why when the government said we will reduce the TDS rate by 25% in the fiscal measure announced by the finance minister, and they said this will result in 50,000 crores. A lot of people are not buying this argument for a very simple reason. If the TDS amount comes down, then I have to pay advance tax. I have to pay advance tax on 15th of June. So therefore, if you reduce the TDS, it doesn't mean I'm absolved from tax. I have to pay advance tax. So if your TDS is not deducted in the month of May, what would have happened? I would have to pay advance tax on 15th of June. So that means that is why a lot of people feel it is not a real stimulus as far as the TDS part is concerned. Instead of TDS, I have to pay advance tax. In fact, advance tax is more headache for me when compared to the TDS. So the fundamental premises here is TDS is a one way of payment of tax. If TDS is not there, I have to pay advance tax. If I not paid advance tax, I have to pay self-assessment tax. Before filing tax returns, I should pay the tax. So what the Supreme Court said, if you have not deducted TDS on my payment, but I have included that in my income and I have paid the tax, then income tax department once again cannot go and recover from you the TDS amount. TDS is not an absolute mode of recovery. It's only one mode of recovery. You can recover through TDS, you can recover through advance tax, you can recover through self-assessment tax. So I am already collected tax from me. Therefore, you cannot once again collect the tax from the deductor. The government accepted this in principle, but while accepting this in principle, what is it? They introduced a section called 201 proviso, which says if you have failed to deduct TDS, you will not be considered as an assessee in default, provided 1, 2, 3, 4. That just read the one which is shown in underlined and blocked. Sum paid to a resident or sum credited amount of the resident shall not be deemed an assessee in default in respect of such tax if such resident. All along, this 201 proviso is applicable only when the payment is made to a resident. That is, I am a resident. I have furnished the written off income. I have taken the amount into my income. I have already paid the tax on this income. And the last point, from my chartered accountant, I should give a certificate from you in a form called Form 26A that I will include this income, I pay the tax. If I give this form to you, then you will not be considered as violated the TDS provisions. So the moment you not considered to violate the TDS provisions, there won't be any disallowance for you under section 40A. Just recall, disallowance under 40A, I will be for a non-resident or payment to a foreign company. 40A IA will be for a payment to a resident. So therefore, if the TDS payment is made to a resident for which 201 proviso is applicable, disallowance will not apply if I give this form. Fortunately or unfortunately, this provision is not there for a payment to a non-resident. It's there only for a payment to a resident. Now let's see what is that they've done. The term resident is substituted with payee. Was not saying resident anymore. Payee. Payee can be both resident or non-resident. So that means what is very important is up to last year, If this Form 26 is taken, you can take only from a resident, and therefore disallowance will not apply only under 40A IA. Now this section has been extended to non-residents also. That means both for 40A and 40A, if I get this Form 26A, disallowance will not apply. Very interesting provision. Most likely in the final, 50-50 in the intermediate. I don't think this is very important. So just we'll move to the last segment of discussion, maybe another 15 minutes. I'm sure I know that it's getting late for most of you. Just give me another 10-15 minutes. Filing of tax returns, all of you will be aware of. Voluntary filing of tax returns is required if for company, firms, or LLP, whether they have income or not, they have to file. However, in the case of an individual HUF, AOP, BOI, return of income is required only if the gross total income exceeds the basic exemption amount. Today we discussed about capital gains. In one of the problems, the capital gains came to zero. Assuming he has got no other income, there is no requirement for him to file because the gross total income has not exceeded after considering exemption order 54. The capital gains is zero. If he has got no other income, the requirement to file does not arise. Ram was asking one question: if he buys two properties, why should you disclose if it's not going to be available in town? Somebody is going to disclose. There are so many avenues are there. Buy a property less than 50 lakhs disclosed. You buy a property, stamp sub-register office will report the transaction. Government gathers information from many sources. But when they gather the information and then try to ask the SEC as to why you are not filed, he comes back and says, I have put the entire amount in 54. There is no taxable capital gains for me. I am not required to file the tax returns. So I'm not able to find out whether you purchased two houses, whether you purchased one house, did you spend the amount? Nothing I could see because you have not filed your tax returns. So therefore, what they have done is from assessment in 2021, if you're claiming exemption under 54, 54B, etc., then you have to file the tax returns if before this exemption your income exceeds the basic exemption amount. For example, if my amount of income, say before capital gains, say is 50 lakhs. So I am claiming exemption under section 54 for 50 lakhs. I don't have any capital gains. My taxable income zero. But before 54, my income has exceeded the basic exemption amount. Therefore, there is a requirement to file the tax returns. Very important amendment. Surely either in the multiple choice question or in a regular question, this will come. No doubt about it. It's a mere certainty for the examination. Now, currently the income tax returns you have to file only with the PAN number. Without PAN number, you cannot file. But what they are now saying is that instead of PAN, you can also use your Aadhaar number. So wherever PAN is required, you can replace it with Aadhaar. So very important provision. However, you have to also link the Aadhaar with your PAN if you have both. But that linking due to the COVID situation has been extended by another 3 months to 30th of June of this year. Now, if you have gross total income exceeding basic exemption amount, you should file. But if your gross total income does not exceed the basic exemption amount, there is no mandatory requirement to file. But the government has found many a times people are going to foreign countries. Vijay will act in a film called Kurivi. People go outside India, bring some television, all those stuff. A lot of people travel, they incur huge expenses on their electricity and they deposit huge cash. But those people always claim that we don't have a taxable income. So therefore, what the government says, boss, if you are depositing 1 crore in a current account, and if you are incurring for yourself and your family 2 lakhs in foreign travel, or if you are incurring for your electricity 1 lakh, then you have to file the tax returns if you say your gross total income has not exceeded the basic exemption limit. So therefore, they are trying to put some more criteria, which is non-income criteria for filing tax returns. So first we saw before 54 series, if your gross total exceeds. Here, if you have done this, you don't have a need to see 2.5 lakhs, all the stuff. To satisfy any one of the three conditions, you have to file the tax returns. So this will apply only when you put in the current account. This will not apply if you put in the savings account. Of course, if you put in the savings account any cash in excess of 10 lakhs, you will be reported. That's a different story. The deposit can be in cash, check, or any other mode. The section never says you should deposit cash. And if the aggregate of all deposits made person in the previous will be taken, and the expenditure may be incurred in cash or check by forex card or any other electronic mode for the foreign travel, either for the assessee himself or for any other person. Now, there's one small interpretation. Don't take this in the examination. I'm just trying to give you another eye opener here. The word here says 2 lakhs for himself or another person. So where do you draw this R? 2 lakhs for himself or another person, or stop 2 lakhs here for himself or another person. So it's just like playing around with one word R. So where is it? 2 lakhs for himself or for any other person. So how do you read? Is 2 lakhs common or which is common? So therefore, there is a possibility that people might take a stand 2 lakhs for himself, 2 lakhs for any other person. But our income tax department come back and say that this 2 lakhs is for these two, himself or other person. Therefore, if I spend 1.5 lakhs for me and another 1 lakh for my mother, crosses 2 lakhs, I may have to file the tax returns. But it appears for your examination, what you should do is take it as this 2 lakhs is for no separate limit, 2 lakhs for himself or another person. Put together 2 lakhs is the stand which you can take in the examination. It is our job to fight, not for you. You just make the life simple for you in the examination. Give a clear note, finish off. So that's on the last point on the filing of tax returns. So if you have any questions, please feel free. I think the only point is that I already. So as far as your question, we are you have to differentiate between the two questions. The question is, can he file is different from should he file. So AOP and cooperative society are different persons. They are not the same. So AOP come under different clause in 2 subsection 31. So cooperative society comes under any other artificial juridical person not falling under any of the six above. They don't come under the same category. That's why they have a different slab. So any other questions you can put in the chat box. So I think the electricity bill is separate, foreign spending is separate. Electricity bill 1 lakh, foreign travel 2 lakh. That's separate. Don't you don't have to combine. So they are all separate limits. Yeah, if I take you also, it will apply. There's no relatives and all. Vignesh, if I take you for any foreign travel, I have to fine. Or you take me to some foreign country and you incur 2 lakhs, you have to fine. So there is nothing in the section to suggest relatives. Any other person is not relatives. See, normally if you go to Burma Bazaar and all, they don't send the relatives. That's why there is one film from Vijay also, Kuruvi. So you'll go there, and so I think if you watch the film, you know what is the concept of Kuruvi. So any other question? So, so hope you guys have enjoyed the session. But so as I already mentioned at the beginning, it's a very very fascinating. Been very good in answering very fast. So what we'll do is we'll plan one more session on multiple choice questions. So MCQs carry 30 marks. So we have to do something on that. So we'll plan a session on MCQ. So again, maybe in MCQ, even more. So you have to put your multiple choice quickly. We'll just find out who puts the button first. I think this class is doing it extremely fast, even the descriptive questions. I think in MCQs we'll play around with speed. So we'll shortly organize that. So so fantastic. So great show by all of you. In fact, I wanted to have the dinner in between, but the class was so this thing. I just for a briefly for 2 minutes had one cup of water and then came back, and I have to normally I finish my dinner at 7:30. So I think you have ensured that like that I don't even have to think about my dinner. So, so that's so good. Once it goes to show that there is no need for, I mean, whether it's a physical classes or those things. So people who interact always interact. That's which I've learned. Thank you. What made the classes very interesting and very lively. And maybe this Saturday or Sunday we will meet again for the MCQs, which forms 30 marks. I think if you are able to crack that, nothing like it. Thank you all once again. See you soon. Okay, friends, thank you. Bye bye. Good night.